All right, welcome everyone to episode 2 of the Prime Haven Capital podcast. We're going to go over in depth, some myths of online of the myth of the asset-based loan and private money. So first thing is private money, and everyone people love to throw around the term private money, calling everything an asset-based loan. The truth, both are misunderstood, and most people what you hear is wrong, and they kind of throw it all in as one kind of bucket. So Mickey, let me ask you, asset-based loans, or what do you think the biggest myth that is out there about asset-based loans, Mickey?
Well, asset-based loans, people are looking for just that their property being enough to do it. And the private industry here for private money, uh, you know, everything is an asset-based loan because it's got to be real estate involved in it, to get the loan. So it is an asset-based loan, but it's not like it used to be back in the day. And back in the day, you could just take your property and use it just for what it's worth and everything else.
No dog.
Nowadays, an asset based loan is almost any loan you do, whether it's private money or with commercial, because that is your asset. They're using that as collateral. But you still have to have, especially in the private money area, you're going to have skin in the game. So it's going to, an asset based loan in private money is yes, they're going to secure it against your asset, but they still need to know that you can make payments and that you have money for closing and down. You know, that's just a hardcore fact. Now, will it change down the road? We don't know because everything in this industry changes quite often, but we have to go with what we have right now. So when people say asset based loan, I usually tell them this is an asset based loan because that's what the loan is because there's real estate attached to it. So it's an asset based loan, but they're still going to have to need docs.
Yeah, exactly, Mickey. You're right. People think, oh, I can come in with a property, I have it at 50% market value. That's all you need. No, it's still documentation. Yes, you don't need W-2s, you don't need tax returns and a bunch of other stuff with a lot of private money loans. That is true. It's lower docs or less docs, you could say. You still need reserves. You still need skin in the game. You need your track record. You need your LLC docs, among other things, because nobody's just handing out. If I have a property and say it's worth $1 million and I'm picking it up for 550, that still doesn't mean that I can just go get a loan at 50% market value. That doesn't mean there's still a loan. Still a loan. I'm still going to have to qualify, and I'm still going to have to put money down, at least 10 to 20%, no matter what. So, you know what I mean, Mickey? So if you want to kind of expand on a little bit of what I just said.
Well, when you're out there looking for a loan, and people say, you know, minimum docs, no docs. When they're saying that, they're talking like what you said, David. No W-2s, no tax returns, but you still got to show that you can pay back the loan. You know, and when they say, it's revenue generated, well, you got to show them that you have the revenue in order to get the loan. You know, the biggest key is when you're reading these different ads that are out there, there's a lot of bait and switch. They put it in the headlines saying all this, but then when you get totally involved in them, then you're going to find out you're still going to need, you know, especially doing an LLC, the operating agreement showing who's all part of the LLC. You're going to have to show the EIN number, showing that you have an EIN number for it. You're going to have to show your income, whether it's in bank statements or, a verification of it. No one's just going to say, okay, David, you want a loan for 500 for $500,000. Minimum docs, all I need is, your your LLC paperwork, but I'm still going to ask to see that you have money in the bank. you know, they're still going to ask for a personal financial statement so they know that you can pay back the loan. You know, it's nothing is never no docs. Minimum docs, yes. And some people will say, well, we're talking about documentation like W-2s and stuff like that, not bank statements. It's all considered docs in this business. Okay, whether it's a personal financial statement, you're going to have to show, you know, the LOI or the purchase agreement for the property. That's documentation. You know, so when they say no docs and stuff like that, you got to ask them, say, what do you mean by no docs? You know, but generally it's the W-2s and the tax returns. Minimum docs is they don't need a whole bunch of docs. They just basically need to know that you have the money. You got, if you're experienced, if you're going with private money that's for experience, you got the experience, you know, and they're going to want to know proof. They're going to want to see a track record. You know, there's always some type of docs involved. You know,
Always, you know. And
always.
other thing that, you know, they want to say, we'll touch on this more as well in a little bit, but you know, some people say, like I watched a video today that I actually put out a stitch on TikTok where the guy just said, you know, I like private money because it's relationship based. They don't really care about your credit. Well, it is relationship based, but they all care about your credit. Hard money, private money, banks, whatever. They're still going to care about your credit score. Now, if you have a small time lender that might be just be a retired doctor, maybe they give you some more leniency on a credit check. But in general, if you're going for a private money loan, because a lot of people say, oh yeah, you can go get 100% financing, you can just find Joe Blow down the street that's lending out his money. It's not as easy as the gurus make it seem. It's not just out there, you know, trying to find 100% financing, stacking that capital together, getting a hard money or private money loan on a lender, and then stacking, you know, some kind of secondary, um, you know, smaller private money lender. It's not as easy as people and as gurus make it seem. So you know what I mean, Mickey? Like they make it seem like, oh, you can just you can go get 100% financing just by any. It's really easy. You want to touch on that?
Well, just like in the previous podcast that we did on episode 1, when people say 100% financing, my first question is how are you going to get me to 100% financing? Okay. Because when you say 100% financing, most people think all the closing costs, all the points, uh, down money is all included in it. There are exceptions to the rule, but 98% of the time, you're going to have to come out with something out of your pocket. Okay. And I say the 2% because, like we said in episode 1, there are certain exceptions to the rules, like the SBA and some other stuff, you know.
Well, that's yeah.
But, you know, it's just, you have to ask questions when they say no docs or minimum docs or 100% financing and stuff like that. I know people are used to back in the 80s and the 90s about, you know, how lending was. Well, we're in 2025 now. Back in the 80s and the 70s, gas was under $1. Now we're paying almost $4 a gallon. Times change. So does the financial industry. And it all fluctuates on the Federal Reserve and stuff like that, you know, and the economy.
And the 10-year Treasury.
Yeah, I was going to get to that in the 10-year Treasury. You know, that's what's going to dictate. You know, so when people mention, you know, private money and asset-based loans, you know, every loan is an asset-based loan. I'm going to repeat myself there because it's got real estate attached to it. You know, private money, you're talking private banks, you're talking hedge funds, you're talking family offices, you're talking about, you know, somebody that's a retired doctor or somebody that wants some cash and they're looking to invest into real estate and stuff like that. But they're just not going to just hand it to you without doing their checking because they're investing in real estate to make money. not to lose money. So they want to make sure that they're going to get something back on their return. You know, I mean, private money is easier than going to a bank, but there's still requirements for it. You know, when you go to the credit score, there's some private money lenders out there, even hard money lenders out there, that credit score plays a factor in it, but it's not the only decision that's making it. They like to hear the story behind it because they know everybody runs into trouble. But if you're on the right path, they may do it for a little lower score than whatnot. But I will be the first one to tell you, your credit score is going to dictate your interest rate. You know, if you're lower, you're going to have a higher interest rate, just like on a credit card. Okay. If you rebuilding your credit, and I'll use that as an example. You get one of them cards, you're paying 34.99% to build your credit. It's a high interest rate. But now if you apply for, say, a Chase MasterCard or Visa card, and you got a 750 or 800, your interest rate may be only 20 or 18% versus 34.99 or 35.99. You know, so just so you know that in a factor, when people say we take credit scores as low as 550, well, your interest rate isn't going to be a 9.5. You'll be lucky if it's a 10.99. It's probably going to be more like 11.99 to probably about 15 something. You know, so be aware of that. You know,
But
so there's just different stuff you have to watch out for. But to answer your question, David, asset-based loans are every loan you do because you got real estate there, unless you're doing some type of business loan. Then that can be the exception to the rule, but everything else is an asset-based loan.
awesome. Yeah. I mean, the biggest thing I want to, really touch with the gurus before we go into the next section is that they will always tell you, go get private money, put a capital stack together of a private money or hard money lender, and then find somebody to bring the money to the table. But it's not that easy. Everyone's not just handing out that kind of money, for a second position, because second positions exist, but they're risky because whoever's in first position is going to get paid out first and get paid back first. So that's why there's not a lot of they're out there, somebody that's going to help you put down a full capital stack and use zero of your own money. All these gurus just always label that. Find zero, put zero of my own money in this deal. I have nothing in this deal. Well, I would advise against that, because then you have no real, like, you can just run away at any time. Like, there's no reason for you to sit in the deal. And if you're not going to put up your own capital, then you don't believe in the deal enough to do it. You know what I mean, Mickey?
No, and you got a point there. When you take out a second position loan, most lenders are going to look at it and ask you why you need a second position loan. Why didn't you get it all in your first one? Or why do you need the cash now? Because in all sense, in reality, David, first and second, you're making two payments.
Yep.
Okay. And second position sometimes doesn't come cheap. Just like when people talk about gap loans and stuff like that, they do not come cheap. And we touched that on the first episode too. You have to be careful, on what you do, And when you come back around for another loan and they see that you're taking all these first and second position loans, they're going to ask and say, why? Because you don't got no skin in the game. You're trying to cover the skin that you're supposed to have in the game by these other loans. And especially if you're on the borderline of making the payments, you can show the reserves and stuff there, but now you got another loan that you gotta pay on. And your first position person is going to get mad when your second position person puts a lien against your property because you missed the payments. They're going to come back at you and try to cash in on their note. So, second positions, yes, you only, on most of the stuff, only paying interest and everything else. And how long do you want to pay 3 to 5% a month on interest on a loan? It's
Exactly.
draining your cash flow.
And it's going to eat into your profit, your fix and flip a
Yeah,
lot. There's not a lot of huge margins inside fix and flips, depending on what you get it at.
yeah.
Now, just remember, everyone, the standard in the industry for a fix and flip and stuff is about 70% ARV for funding. And most people will do 80 to 90% of the purchase and 100% of the rehab, or just totally 85 to 90% loan to cost. And that's your skin in the game. And just so you guys know, loan to cost is basically the total project cost that's being funded. The total project cost that's being funded. So that the lender is willing to fund. So you guys really got to look into that. Make sure you do it. Now, the other thing I want to touch on just real quick is that when you're looking at comps and you're trying to prove your ARV, never ever use Zillow, because Zillow swings in 10 to 15% in either direction. It's not a good metric. My father is a real estate broker of over 30 years in the Los Angeles area, and he preaches that to me. So never ever use Zillow if you're trying to find your comps for ARV or even just pure value of what you're going to buy it. And the other thing is, when you're doing a fix and flip, you got to get it at least 25 to 30% under market value. Just wanted a quick touch on that. Now, the other thing I want to go over, Mickey, is the myth of online. I just hear so many people use the term private money as some colloquial term that's just thrown in all these buckets. Because Mickey touched on it earlier. You got a few different pools. You got the independent, which is like a retired doctor or family and friends. Just some independent guy. You also might have so a pool of people. A little, just a pool of like 10, 15 people that pool their money together, that's lending it out, or just a fund, a small fund as well. And then you got institutional, you got hedge funds, you got REITs and everything else that'll fund bigger deals. So when you're really looking at private money, you got to look at which bucket are you talking about? Because when you have these guys online, these gurus that just talk about private money to make it sound good, but there's more to it and there's way more under the hood. And if you don't understand it, you're going to get burned. So Mickey, what do you want to say right off to the bat to these gurus that just use private money like it's some kind of catch-all term?
Well, they're using it to lure people in. Okay. They're putting it out there and they're using the word private money loosely. Just like I see a lot of people out there for hard money, but then I see the stories afterwards. Well, we had everything all closed and everything else and whatnot, and we're getting ready to close, and they tell us that they ran out of money. Okay. When I see that, that's telling me that if it is a true private money lender, they went to one of the other ones, which was a small group or one individual or one or two individuals where they're lending out money and they're looking for returns to come back in, but they say they have the money because they're counting on the payments and the money coming back on their investment. But if somebody has a hiccup, now it just affected your loan. Now they don't got the money in there to disperse out to you. So when you go into private money, like David said, you got to see which category or what hat, if you want to call it, that you want to go with. Okay. And ask for proof of funds, especially if they're a smaller group, so you don't get to the 9th hour of closing and they say, we can't close because we ran out of money. Okay. You got to be able to ask questions. And I'll tell you this, like I tell everybody else that I talk to, there is no such thing as a stupid question. Ask it. If you don't know it, the person you're talking to should know the answer to it, or be able to explain it better to you. If they can't, I'd just say, okay, thank you, and move on to the next one. But they use the word private money really loosely because private money covers a lot of sectors. Hard money even falls into private money. You know, so when you say private money, that's a large umbrella. Okay. You know, so, you know, ask questions when you're talking to somebody, whether it's us or somebody else or whatnot. I encourage questions when I talk to people because I want to make sure they understand what we do, how it works, and what to expect, you know, and then move forward to there. No.
I like that. I like that. But, you know, because a lot of people, they're just throwing it out there like private money sounds like a casual check from just a rich uncle. No rules, no underwriting. But in reality, true private money is structured lending. There's due diligence, there's terms, there's points, there's risk management, everything, A to Z. Now, what I do encourage is because actually finding true direct lenders, I see all the time people like, I only want to work with a direct lender. It's hard to find direct lenders, and that's why we do actually advise you. And I know we are a consulting firm to go through consultants and brokers because we're out there. We're your first line of defense. We're going to bring you the right lender that's going to help you with your project and vet the lender for you. And we've worked with them in the past and everything like that. And if you don't, if you just go into all these lenders, especially with all these ads all over Facebook and online and Google, you might get burned because the truth is a lot of them, just like Mickey said, they might run out of money because it's a small group or, this one thing or another, or you might get scammed because of an upfront fee or this or that.
Well, let me add on to that, David. I mean, I know in a bunch of these groups on Facebook, that's like you said, David, they want to deal with direct lenders. Okay, 98% of the direct lenders out there aren't going to be in those groups. Okay, yep. They do their own advertising to draw people into there, and they rely a lot on consultants and brokers. Okay, that's what they rely on a lot besides their advertising. Because the consultants and the brokers are going to do most of the legwork for them. That way they can analyze the deal and send it there. And they use the consultant brokers to weed out the BS. And get straight to the deal. But there are direct lenders that you can reach through either advertising or they will send out stuff there. I can't say 100% in each one of these groups that there aren't lenders in there, direct lenders, but most of them that I've talked to while we've been here and that are partners with us, they don't go fishing in them areas. They let us do that and bring them the deal.
9 times out of 10, yep. So, the thing is, both myths exist, because people want shortcuts. They always want shortcuts. They want easy money. They want no money down, nothing out of pocket. Private money sounds easy, asset-based sounds easy, but both require structure, due diligence, and real numbers. And lenders who sell those myths are either predatory or hiding equity plays. Same thing with consultants and brokers. Everyone in this game, it's regulated, but it's not that regulated. So you got to watch out for yourself. You got to double check, who you're working with, making sure that lender, is reputable. And you got to just make sure on that, So, Mickey, what else do you want to tie back into the two myths together just before we wrap up here?
No, I mean, I said pretty much that what it is. I mean, my thing to it is ask questions. But when people say, I'm looking for an asset-based loan, my usual reply to them is all private money is asset-based because it's all tied to real estate. Okay. And as far as private money goes, I tell them that we do private money, and we have partners that have that we deal with partners that have private money. But that, like I said, private money is a large umbrella. Hard money falls underneath there. Uncle Joe falls underneath there. You know, small hedge funds, big hedge funds, small family offices, big family offices. They all fall underneath there. You know, so when you say private money, that's a large area. It's not just one individual. You know, it's a large area. So, you know,
Exactly. So, I mean, private money isn't the Wild West as much as it used to be. And asset base doesn't mean anything goes. So, if you really want to know what deals really qualify, connect with us directly on Facebook, Instagram, TikTok. We're everywhere, X, LinkedIn. We're here to help you out, here to help you structure your deal. We actually just helped a individual who is newer, help him structure a brand new deal. So, and gave him advice because he was overpaying for the deal. So you got to, connect with us. We're going to get it. We have a book coming out. It'll be named shortly, but the book will be out in the next couple weeks. That book will give real insider knowledge with the industry and really showing people, the insider knowledge of the industry. And we're also, going to be launching a club soon / course to really deep dive on to teaching you guys everything. But stay tuned. We'll be releasing a podcast once a week and really doing a deep dive on the industry and giving you guys the insider knowledge that nobody wants to give you because they want to protect it for themselves or they want to, get easy clicks and get social media. So connect with us. Go to primehavencapital.com. Connect with us on Facebook, Instagram, TikTok, LinkedIn. And we will see you in the next episode. Mickey, you got anything before we wrap the end of this?
no, I'm good.
All right. Well, everyone have a great rest of their day, and I hope you guys enjoy the episode.